Hello, and welcome to this episode of the Blue Collar Wealth Club podcast. I am your host, Jerry Garcia. We got a special guest with us today. We got Gregg Gruehl, and he's going to talk to us about, investing in multifamily and his past in fix and flips, and talk to us a little bit about his company. How you doing, Greg?
I'm doing great. I will make one correction. We do have some fix and flips and stuff, but we don't do any multifamily. We're industrial focused.
Industrial, excuse me. Yes, thank you for the correction.
No worries. Thank you for having me on, Jerry.
Awesome. So why don't you tell us a little bit about your background and kind of how you came to be where you're at?
Yeah, so I mean on the realist where I'm at today, we can backtrack all the way 80 years to when my great grandmother actually got her real estate license in 1942. During World War II, when my great grandfather was over fighting the Germans, ultimately passed away. But that is how she supported my grandfather as a single mother through the 40s, 50s, and 60s. My grandfather kind of followed in her footsteps as a real estate agent as well. We actually have her license from 1942 in my office at home, and
That's awesome.
so it's very cool. It's very nostalgic. We have some of her yard signs too. They're very generic back then. They're not as cool as they are today. No pictures of people on them. Just a phone number and a name. That's it. And so really, and then my dad, my grandpa he ran through multiple careers as he was supporting my dad and my uncle from a young age. And so my dad, he went to college, graduated, and became a commercial broker, focused primarily on retail properties. So I've been around real estate really since I was born, and he was the biggest influence on and me and my brother when it comes to real estate. We were always going through old vacant Rite Aid buildings, Aldi buildings, Pizza Huts, you name it. We were going and seeing the gist of the real estate world and the transactions taking place. And so, all through my life, you saw the ups and downs of real estate brokerage. My dad was never like the big corporate guy with a ton of corporate clients, so he was kind of fluctuating, right? He had a couple clients, but his business was up and down based on what those clients were doing. So, as I was coming to, going to college, I wanted to study finance, but my ultimate goal was to still be in real estate, but to do it more on the principal side. So I wasn't interested in being a broker because I viewed the steady paycheck as more safe because I saw things like 08, 09 happen with real estate and saw my dad's income fluctuate heavily. And I didn't, believe in that, and I felt that was safer. So I went and worked on it with some of the largest principals that I could. At my first job out of college was with VDR. It's now named Site Centers. They were at one time the largest shopping center owners throughout the country. Ultimately, they were going through some layoffs. So in my first role was a rotational program, and then you landed a full-time job after you got through the rotation. They ultimately laid off like 60% of the company. I wasn't laid off. I was offered a full-time job to move from Ohio to Chicago and make only $5,000 more. If you don't know, in the Midwest, Ohio is a lot cheaper to live in than Chicago. So making only $5,000
Right.
more was a pay reduction.
Yep.
So ultimately from there, retail, shopping center focused, when retail was going through struggles, Amazon had just bought Whole Foods. So everyone thought, oh man, grocery's done, except for Whole Foods and Amazon are going to take over the world on grocery. Shopping center's done. Everybody's going to. So, this is like circa 2014, 2015, when everyone thought retail was going to start declining massively. Ultimately, I think that's proven a little bit false. But I will say, so I felt like, okay, this business is struggling. They're doing layoffs, and retail is struggling right now. Where can I go? So then I landed at a multifamily firm, which has grown to now 4 billion in assets under management. So large multifamily firm. Worked in asset management, but still didn't really feel like that was my kind of calling because I didn't really like the business to consumer asset management. There meant really analyzing the finances and, going through operating statements also, as well as trying to figure out how to drive leasing. A lot of that business was student housing too. So it was about pre-leasing for the next year. And so there was a lot of focus on, can we give a gift card to drive leasing this week or concert tickets? And that does work. And, but I didn't find that ultimately that interesting to me. So At the same time, my wife decided to take a role out in California, so she moved us out to California. And I landed at probably one of the most well-funded real estate startups that it could have been. Blackstone, the largest private equity fund firm in the world, was getting back into industrial. They had sold it off in 2015 and they wanted to get back in, so they were buying portfolios. Um, so at that time, I happened to land at their firm, which at the time was called Gateway Industrial Properties, now called Link Logistics, the second largest owner of industrial in the United States today. From when I started, they had 80 million square feet, and now they have over 500 million square feet. And almost all of that was acquired, for the majority of that was acquired when I was there in those 3 years. And I was employee 18, got to do a lot of leasing. And leasing in that world is negotiations with businesses. And that's where I really found my stride, was in that business to business connections and negotiations, which is where I really found that I thrived. So that all said, life was going good. Well, during that time was also my wife found out she was pregnant with our son at the week that all the offices shut down for COVID. And
Oh,
we were in
jeez.
Southern California, a few thousand miles from my family, and we were in 650 square feet during the whole pregnancy, with both of us not working, and her dealing with PPE because she was in healthcare, and me dealing with tenants asking for rent relief all day. So
Right.
we were on the phones all day in this tiny little apartment. Then fast forward, we have my son, and we're not able to even really go outside or go to the beach or do any of that stuff in California because the lockdowns were so strict. And so, more or less, we were kind of losing our minds being there. So we wanted to move back to Ohio and get back to where our friends and family were, and get kind of out of those lockdowns and out of that 650 square foot apartment. So took a role working for Stag Industrial, which is one of the larger public REITs that owns industrial, probably top 5 in the country. They own over 100 million square feet to do acquisitions. So in California, I was in asset management and lease negotiation. And when I moved back to Ohio, I took an acquisitions role to kind of round out my real estate background. So I kind of understood operations and leasing as well as acquiring the property. And
Yeah, it's a
so,
pretty diverse.
yeah, it's absolutely. My rotational program in shopping centers was mostly focused on property management, then go to asset management and multifamily, learn how that operated, then jumped to Link and started doing lease negotiations and asset management there, which looked slightly different than asset management in multifamily, actually very different, honestly. And then acquisitions for Stag, covering the Midwest and part of the Mid Atlantic. So really, kind of to round out like the whole real estate background. Um, Stag's team, this past year, I was there for 3 years in acquisitions. I did 5 transactions worth almost $300 million. Sounds like a big figure, but Stag's team ultimately was set up for pre 2022 when the Fed raised rates. They were doing 70 deals a year, where after that it was about 18, 19 deals a year. And so there wasn't really a need for a lot of the employees on the acquisition side. So unfortunately, I was downsized, and I was downsized on Thursday. By Monday morning, I was in the office with my brother starting this firm, which is where we're at today, and we can kind of get into where that started and how that's gone over the last, call it, 8 months now.
Yeah, so yeah, you've seen a lot of these big changes. I mean, you saw the residential crash, like you mentioned, '08, '09, and on the retail side, office buildings in particular, you saw that,
Mm-hmm.
post COVID, a lot of guys, you know, going to remote work or at least kind of cutting down the amount of staff they had to have in person. And you've seen a lot of the effects of that. I know that there's been some pretty significant office buildings here in Denver that have sold for pennies on the dollar of what was owed on them and what was paid for the last time they were sold. So yeah, so you've seen some of the harder sides of it, and industrial is an interesting kind of category. It's just a lot different than some of the other categories, but there's a lot of opportunity there. So so tell us a little bit about kind of what you guys are doing now.
Yeah, so industrial, yeah, as you mentioned, like you said, it is different. Most people they can understand multifamily. Like most people have rented an apartment at some point in their life or rented a house. They also understand generally, like there's a lot of education out there around buying a duplex, buying a fourplex, getting up to 8, maybe 100, and then syndicating some capital to buy some smaller multifamily properties. Um, and people understand office because they've almost all worked in an office at some point in their life, right? And everybody shops in retail. But what most people don't really understand on the industrial side, when they just see those ugly rectangles in their minds, is that the business that's operating there is how goods flow throughout the US, right? Logistically. Everything we own, your microphone, my headset, the desk, the computers, all of this has been in a warehouse somewhere in the US and probably multiple warehouses. And every component that makes them up has been in a warehouse somewhere in the world as well. So, and most people don't realize that the tenants in those buildings don't actually own those buildings. They lease them for the most part.
Right.
So it's one of those worlds where not a ton of people have access to. When you're dealing with industrial, like on a Class A or Class B side, it's not your auto mechanic garages. It's more like your Amazons and Home Depots. It's your 3PLs. It's your lumber yards. It's your nail manufacturing. Hey, I've even been in SpaceX's manufacturing facility where they manufacture the rockets in Hawthorne, California. So if you like, it's everything that runs the gambit of what makes the economy tick. And so, when I was starting my firm, I thought, okay, we can't compete with institutions. We can't go and buy $20 million deals with these, call it A credit tenants like an Amazon or Home Depot. And those deals are even larger than 20 million. Those are probably more like 50 million. The returns on those are very low. And honestly, I'm not going to provide a surety of close to the other institutions selling the asset. So we really looked at that and said, okay, let's stay around 10 million or less on our project size. Let's go with a little bit of, maybe a more tertiary asset, or maybe closer to Class C where we do some value add. And we said, okay, but so we started looking in that realm, and we said, we were getting kind of feedback that it was harder to raise investor funds, honestly, because the returns are tighter. So in multifamily, a lot of people, put together these deals, and a lot of them will say, like, we're going to upgrade X amount of units every month, all these things. But there's a lot of variables that could affect the returns they're projecting. So like your expected return compared to what is the projected return is much different when you're risk adjusting, right? But the difference in industrial is in the leases, they're not year to year with 250 people.
Right.
It's with a company whose lease doesn't roll for 3 to 10 years.
Right.
And those lease rates grow contractually every year. The new norm today is nothing lower than 3%. So you're getting a 3% rent escalation every year with the same tenant who, some of them aren't credit worthy, obviously, like some businesses do fail, obviously, but at the same token, mostly you're going to get that rent check. It's more consistent. So when I'm giving a projected return, it's closer to the expected return, but it is also likely lower than what I can't go out and say I'm going to do a 20 IRR by changing the granite countertops, or upgrading to stainless steel appliances from black or white plastic, right? Like that doesn't, and ultimately, I've known from my multifamily operators that I do know personally, it's like, it doesn't actually increase the rent as much as some people think. But that's not the point. The thing is, so it was harder to get people focused on it because the returns were lower when they were getting pitched juicier deals that may or may not actually return more in the long run. So we started kind of doubling down on more of the value add, where we could add capital and bring capital to deals that improved a property to increase the rent. So in that realm, in industrial, we were focused on either expanding the building or adding industrial outside storage. So that's like adding trailer parking or just adding anywhere buildings that had excess land to be able to either pave that lot or expand the building. That was basically the gist of what we were trying to find. Also very hard to find. So we're kind of looking at that box right now, and we're still doing that because the returns are higher. And then we are also looking at ground up development. All of this per se now, the main focus is to keep it sub 100,000 square feet though. So that we can focus on the smaller tenants where vacancy rates are less. So the headline vacancy in Columbus this past quarter is almost 9%. But if you look at that, that is Big Lots filed bankruptcy and gave back 3 million square feet. Okay, so that's a
Oof.
big building. Okay,
Sure.
so that adds a lot of that adds almost 100 basis points to the vacancy rate in Columbus
Hmm.
alone, just that building. Then if you look at it, if you look at buildings with spaces, if you look at suites that are smaller than 50,000, you only see that vacancy rates are 2%. So there's still a high demand and low vacancy rate in the smaller suite spaces that are servicing mostly smaller businesses. You can still find some bigger businesses in 30 to 50,000 square feet, but in 10,000 square feet, that's very rare. So our focus is in the smaller business segment, servicing smaller businesses, call it, by taking a 100,000 square foot building and chopping that up to maybe 5 tenants, or like a 50,000 square foot building being 3 or 4 tenants, right? So we're really servicing the smaller tenant, and we're looking at, call it regionally, Columbus, Cleveland, Cincinnati, Louisville, and then we also go out to the Mid Atlantic where I covered for Stag as well, and looking at markets like Richmond, Virginia.
Awesome. And yeah, there's a good point there about like the multifamily versus the industrial, right? You're talking about kind of rolling vacancy. Every time a lease is up, you don't know if that tenant's going to renew. You don't know how much work is going to have to be done on that unit once that person does vacate. You have a higher eviction rate, I assume, than you would in the industrial side. So, while the returns may not look from a percentage wise as sexy as maybe multifamily at least projects to be, I think a lot more of that consistent growth, that's solid and steady. I think there's a lot more opportunity there, and I think that's a different niche that most people aren't looking at.
Yeah, and I would say that's probably why the investor is not typically a retail investor. Like you don't see many people out there saying we're going to syndicate funds for industrial, right? And the industrial investor is a few things. It's family offices taking the whole equity stack. It's big private equity funds. It's public REITs, and then it's owner occupants where the actual business in there owns the building. That's kind of
Yeah.
the group of people that own it. It's not the same in that multifamily. People aren't scared in multifamily if a sponsor who's bidding on a property that's fully marketed, they aren't scared when somebody says, "Hey, I'm actually going to raise $10 million equity from syndications," if they have a track record of it. When I do that in industrial, people are like, "Nobody, you better come with one equity check," because they don't believe you're going to close, because it's just not how they operate. And the other thing, and I think people can take a page out of family offices who are, obviously very wealthy individuals that have built probably a business or their family has historically, right? And so they're looking at it like, oh, we get these great stable returns. And to your point on the evictions, if you're studying the financials, very, very infrequent. Also, the typical retention on a tenant across like a portfolio, like a Link or a Prologis, like the big firms, Stag, there's 70 to 80% retention. So tenants are renewing. And when you're renewing in those realms, it's a little bit different. Like with turnover in multifamily, if they've been there a while, you might be renovating the unit. In the case of industrial, that's kind of baked in with what's called tenant improvements. So you don't really get a benefit if you give tenant improvement allowance to like really up the rent. You might get somewhere in your market, but you're not gonna, again, same example, like change the appliances and get more rent. It's kind of like a foregone conclusion that you're most likely going to give some tenant improvement allowance if that's a market condition at the time. It depends on
Right.
whether it's a landlord favored market or not. Say in these bulk buildings where there's a lot of vacancy right now because of all the pent up development that happened during the COVID period on bigger spaces, call it spaces bigger than 200,000 square feet, those landlords are giving a ton of concessions for their leases and tenant improvements and free rent. In the smaller space, you're going to have to give a lot less if the space is existing. If you're doing ground up development, you're going to do an office build out. That's just a foregone conclusion. Otherwise, you basically have a dead storage space.
Right. Right. It's interesting, and I'm sure the leases are a lot different in the terms. I mean, as far as kind of how they operate, who's responsible for what expenses, and and that can have a big impact on the returns as well, right?
Yeah, so in your multifamily, they're obviously more like a gross lease, right? Like they're paying the
Right.
rent and the landlord eats any expense fluctuations. In the case of these industrial deals, what the type of class I'm talking about is all triple net. So we're passing through any expense spikes. So say insurance goes up like wildly like it has, that's passed through the tenant. Say your taxes go way up, that's passed through the tenant. Say they damage the parking lot, pass through the tenant, so you don't incur those expenses. So it's steady. Whereas in multifamily, you have one of those things hit, especially like people who have, let's say it's a duplex in single family or duplex or multifamily. You lose the tenant, you're losing your rent for those months. You have a $12,000 expense on capex, that might be your whole cash flow for the entire year, right? On smaller assets. So in this case, these are all things that are passed through to the businesses as business expenses. And the beauty for the occupier, tenant, or business, however you want to label the occupier of the building, this is the real estate piece is usually only about 6 to 8% of their operating budget. So it's a very small piece when you compare it to usually logistics and employment is their two biggest buckets typically when looking at a location for a warehouse. So when you have tight vacancy rates, you can definitely push on rents because moving the needle at 6% of their operating budget and moving up their rent 25 cents per square foot in a month isn't going to make them, lose their minds, right? Because it doesn't change their operating budget so much. It's such a small piece of the pie. So that's why rents have actually grown substantially over the last few years as well, even in big bulk million square foot spaces, because it is usually such a small piece of the operating pie. Like an Amazon warehouse that operates 100 or like a million square feet that's like a 6%. I mean, everything's driven by their vans and how much they
Right.
have to drive in their trucks, not the real estate.
Yeah, and that's exactly what I was talking about. Those triple net leases are always what have interested me in industrial because, we're used to, like you said, if you own a property and, just say it's a single family and, something goes out, washing machine goes out, whatever, and if that's owned by you, you have to replace it for the tenant. If there's a problem with the furnace or the AC, that's an expense to the owner, and that takes a big chunk out of your profits for the year. And those types of expenses can be expected every so often. Now, if you're a good landlord, you've built that kind of expectation into your projections when you're kind of building out your rent. But you know, if you hit a couple of those in a row, all of a sudden this house is losing you money for 2-3 years until you're getting back on your feet.
Right. Yeah. I mean, a capex reserve that's underwritten is only so good because it's not capex reserve as a percentage of your revenue is very small. And if it's a single family house, you need to own a lot of doors to get rid of that risk. You need to
Right.
own 100 doors to get rid of that risk because five of those doors or houses per year are going to have some sort of issue that are eating up the capex reserve of all of the ones that you budgeted for across all your properties. And that's why people do like multifamily because it kind of hedges that too, because you're going to get 300 doors in one location. So you are hedging those expense issues, but there are some systemic expense issues like insurance that put people underwater or fluctuating debt rates. Now that's obviously not passed through on the tenant side, on
Right.
industrial either, but there's different ways that triple nets, insulate you against those things. As long as the key really at the end of the day is making sure you have financial review rights of the business that is leasing your space. So in the big world, in the big leases with the big shops that I've worked at, we can audit your financials every quarter if we would like. They don't usually request it that often. You maybe more like annually,
Right.
and obviously before leasing, you do as well
Sure.
the space to them. So as long as you're checking on those things and you have a decent understanding of how business financials operate, you're going to have a pretty good understanding of your risk on the tenant side.
Yeah, and I think, like you said, I think that's something that most people don't understand about these triple net leases is it does take a lot of those expenses off of the landlord's plate, and it makes it a lot easier to project your returns. You mentioned family offices invest in these pretty heavily, it makes sense, because typically family offices are taking this giant chunk of money that they have and they're diversifying it, and industrial is an area that not a lot of common, more common investors are looking at. So it's much easier for them to make a couple relationships with guys who are in that space, which they're few and far between, and really kind of take that solid growth return that's pretty stable and add that as one of their mainstays to their portfolio.
100%. I mean, what it really looks like is they look at it this way. They say, okay, we have multifamily, we'll have industrial too. When I look at, we'll just use random numbers here, but let's say the multifamily projection from the sponsor comes at 20. And if you risk adjust that, let's say it's like they actually get 12 out. Okay. If I give you something that says 12, I would say you're going to only be within like 100 basis points on either side of that,
Right.
right? Like you're not going to have this huge inflection. Now, again, that all depends on how you underwrite your exit for your exit cap rates on the rent. Now, in the deals that I'm looking at today, we are focused we're looking at a couple of build to suit options where the tenant is come to us to build a building that they're going to lease from us for a number of years. In a couple of those situations, the exit doesn't matter as much because we're going to hold this for a very long time, and it plays a very small part in the overall yield of the deal that is projected. And you can manipulate a deal to look good by making your exit cap compress or your debt rates on your refis much lower. And so what I would caution investors always to do is to understand how a operator or sponsor is looking at their exit, because that's going to be your biggest effect on how the yield looks and on the yield projections. And to be honest with you, anybody that's underwriting compression on interest rates or cap rates is being very aggressively bullish. So I'd question that. And then that would cause me to question a whole host of other things.
Right.
Because we're not living in a world where interest rates are going down to zero on the Fed and then the overall actual 10 years going down to almost nothing. That's not the world we lived in anymore. So it's hard to underwrite compression as your base case, but it'll make everything look good, and you can probably raise a good amount of capital on that, but you might not have repeat investors.
Well, yeah, and that's the key, right? Being overly optimistic about those scenarios, has a worse long term effect on your investors and your reputation with those investors.
Right.
So, tell me, I mean, I guess as somebody who was just trying to get into investing, say you've got a business owner who's finally got their business in line and they're looking to make some sort of investment. Like you said, this is kind of a harder kind of category to jump into. What's the best way if somebody was interested in something like this to kind of get started?
Yeah, so if you are a business owner and you've made it to the point where now you're investing your free cash flow, what I would tell you is have a diversified portfolio of different types of asset classes. But so I'm not saying multifamily is bad when I talk about multifamily. It's a great asset class and people should invest in it. But you should also think about sprinkling in things like industrial as well, because it offers a different flavor. Like if there's a downturn in multifamily and I have a 10-year lease with a tenant, we know the cash flows are not fluctuating, right? So I would tell your business owner, reach out to me, of course, but shameless plug. But honestly, it is very hard to get into. So what I would tell you is if you can find or network with, if you're specifically looking in your home market versus like say if you're in Denver like you are and investing with me in Ohio, if you want to invest in Denver, I would say the best way would be to start by asking some of the real estate brokers that specialize in industrial properties at some of the bigger industrial or the bigger brokerage firms like a CBRE or JLL. See if you can get to network with those guys, especially if you're a business owner that occupies industrial. They'll definitely take your call because they might think of you as an opportunity for more business too. So it'll help you get an understanding. And that's where it's also tough because a lot of the knowledge is tied up with brokers where you can go on Zillow, apartments.com, find out what rents cost. You can see a lot of the residential or small multifamily is even listed on Redfin or the MLS. So you can see it without having to get to know the brokers. In the industrial space, the knowledge is all typically contained with different brokers. So that's where that also makes it tough because it's almost gate kept. So you have to find somebody who has a background in it. And I will tell you, there are very few people syndicating call it these smaller share investors in the industrial space. I do offer some education in it, and I'm happy to talk to anybody about it, even if they don't invest with me and they're just interested. I've had numerous people listen to my other podcasts I've been on call me about a site down in Texas and just have me give them advice because it's zoned industrial, but it's not something I can do. Or same thing in Nashville as well. And it's not something where the type of asset that I work on, but it just finding the right people, through a network is the best way I can tell you to do it.
Awesome. Well, on that note, if somebody wants to kind of learn more and kind of figure out what you or your company, Gruehl Capital Management Partners, is doing, what's the best way they can get in contact with you?
Yeah, so I would say honestly, that's probably through LinkedIn is the best way. Also, just my personal email as well, Greg at Gruehl Capital Management or at greelcmp.com is the best way. But I would look at LinkedIn. There's ways to get in touch with me, book a call with me. I'm always happy to chat with really anybody that wants to talk industrial or learn about it. Whether or not you're an investor with me, that makes no difference. If you're interested, I love talking about it.
Absolutely. And we'll definitely put your contact info in the show notes. One more thing before we kind of exit this interview. What's a good book that you recommend to anybody, just to kind of get any sort of the knowledge that you think is important to kind of get their journey started?
It's funny to get the journey started, in real estate, everybody points to the purple book, Rich Dad, Poor Dad.
Always.
Everybody's read that always. And so I will tell you that, yes, I have read that book and numerous other financial books over the years. But I'm going to go with a little bit different one. And this one's more about mindset. I enjoy David Goggins, his stuff. So Can't Hurt Me. And then I don't remember the name of the second book. But really, it's more about of a mindset of being able to push through hard times. Is if you boil that book down to its core, and keep going. And so, life is wonderful if you keep going. Through the hard times and through things, as we were kind of discussing before recording the show. Like things pop up, and you just gotta handle them, right? So that's where I would start, because you got to get in the right frame of mind to really go after your blue collar business, and really, keep going. Some days you don't feel like doing it. And that book provides some perspective on life, that your life's probably not that hard, in most cases. So, you can keep on going.
Yeah, absolutely. I think that's solid advice. I like that a little bit different because, like you said, everybody in the real estate realm is always going to start with Rich Dad, Poor Dad, which is a great book, and everybody should read it because it is good for shifting your way of thinking. But no, I think getting that mindset right and getting yourself in the kind of mental space to be able to kind of really attack life, I think those books are equally as important. I'm always a fan of Tim Grover's Relentless as another one of those types of books.
100%.
Yeah, so awesome. Well, thank you so much for taking the time to come on the show here. Like I said, I'll throw all your contact info in the show notes. That way, if anybody wants to get in touch with you and talk about this very specific niche and kind of, if they're interested, how to get started, there's a lot to uncover there for sure, because there's not as much material, as you said, on industrial as there are other types of real estate.
Awesome. I appreciate your time, Jerry, and thank you for having me.
Absolutely. We'll have to have you on again soon.
Thank you very much.
All right. Well, that does it for this episode, guys, and thank you, and we'll catch you on the next one.